if you haven't heard by now, the California property insurance market is in shambles. Prices are skyrocketing, people are getting kicked off of their plans, and insurers are leaving the state in droves. What is going on, and is there any end in sight? If you've checked out my you have some idea where this is going in terms of what's going on and who to blame. And if you want the full answers to the California crisis, then stick around. Before we get started, this is Clear Money Tea. Thanks for stopping by. Please like, comment, and subscribe. All right, let's get into it. There are three major reasons insurance crisis, and those are wildfire risks, home prices, and regulatory issues. All right, so let's start with the first one, wildfire risks. Wildfire risks in California have definitely been increasing in terms of intensity, duration, and frequency these past few years. The reasons for it have been coming down to issues such as climate change and people being stupid. And when it comes to insurance, the 2017 wildfires, those ones were pretty catastrophic, and insurers are much more conservative after that. Compounding issues, there's definitely been much more building that's been occurring out east in California. So people have been looking to escape the high prices of the coast and have been going more inland to kind of get some cheaper prices. Unfortunately, when you take a look at the median income and you take a look at the wildfire risk as described by FEMA, you can definitely see that it's going to be an issue. The average median income is lower in some of these higher risk areas. So people who've been looking for affordability are unfortunately getting screwed now. On the other end of the spectrum, we have pretty high property value homes in wildfire risk areas as well, and those ones are currently being dropped. So think LA Hills areas. And you can see here that State Farm, which is California's biggest property insurer, has dropped a lot of policies in wealthy zip codes. State Farm is sometimes the only insurer in some of these higher risk areas. So them dropping out or just insurers dropping out is a big issue because then people get shifted to the insurer of last resort, and that causes plenty of other issues, which I'll talk about later on in the video. On the positive side, there is a lot that can be done to help with the wildfire risk. That comes down to funding forestry management to reduce wildfire risk. And of course, if you want to reduce the wildfire risk on properties, then you're going to want to reduce building in wildfire prone areas. And charging more for insurance in areas where there's high wildfire risk helps reduce the demand for those areas. So we can see this work. For example, this person said that their son works for a hotshot crew and wants to buy a home in the area but can't due to the cost of fire insurance. So this is something that's really unfortunate, but this is something that we do need more in terms of these free market levers to reduce demand in high wildfire risk prone areas. Wildfire risk isn't the only reason why insurers are leaving California and prices are being elevated. So another one that's cited, but less popularly so by news networks, is definitely the impact of housing prices and building cost on insurance. So of course it's expensive to buy in California and it's also expensive to build. So what does that mean? So that means, for example, if your house burns down in a fire, it's going to be expensive for you to rebuild, which means it's going to be expensive for your insurer to rebuild your property. So this means higher premiums. However, there are really effective ways that you can combat this. So the two ones really come down to building more homes in low risk areas. This can have a really big impact on reducing prices or slowing the rate of increase on home prices. So if you take a look at, for example, Austin, Texas, who have been building a ton of housing, you can see the impact of that there. So really the impact of this cannot be overstated enough. When you build more housing to meet demand, housing prices stabilize. Workers are less likely to require or demand higher wages to keep up with inflation because the inflation of housing has decreased, which is a major component of people's costs. So if people aren't demanding higher wages as much, that also reduces the labor cost component of building houses as well. And the second one is reducing the red tape for building. This will help lower the cost if you can get rid of some of these lower value regulations that really just add to the cost and add to the time that it takes to build houses. All right, so the next issue that I'm going to go over is regulatory burden. California definitely has a reputation of being overly restrictive when it comes to regulation. So this last issue of regulatory burden, there are actually three components to it. So the first part of the regulatory burden is that insurance companies are unable to incorporate the full cost predicted and actual current cost into the rates that they set. So for example, for future predictive costs, they can't incorporate predictive wildfire risk into their rates. So that's problematic if there's an area that you know is now prone for wildfire risk, but you can't charge for it until a fire has actually occurred. That essentially is a ticking time bomb waiting to explode. Of course, that's also why some insurers are leaving, because they're forecasting risk and they can't charge for them. When it comes to not being able to incorporate actual costs, there's this thing called reinsurance. So if you don't know, insurance companies also take out insurance themselves, and that is called reinsurance. However, they actually can't incorporate the cost of reinsurance into their rates that they're charging. And reinsurance costs for insurance companies are going up right now. So insurance companies can't charge for all predictive risks, and they can't charge for all current costs that they have as well. And so that's why some of these insurance companies are leaving. On the flip side, which is good, the insurance commissioner Laura has been advancing his sustainable insurance strategy announced September 2023, which is California's proposed plan to help deal with this issue. And it addresses both the reinsurance issue as well as allowing insurance companies to incorporate predictive wildfire risks into their pricing. And insurance company Allstate said that they would re-enter the property insurance market in California once those two issues have been addressed. So that's pretty promising for the future. All right, so the next portion of the regulatory issues includes just like the rate hike process in general. Insurance companies for, property insurance and other types of insurance, they often need to get approval from the state to get the rate hikes processed. So there is some benefit to the consumer here. So if you think about it, you need to get property insurance if you're going to have a mortgage on your property. So having a mechanism to control pricing so that insurance companies aren't just charging whatever to a captive market is a benefit. However, the actual process itself is quite lengthy in California. It can be 6 months and it can go all the way to like a year plus. And it's just like much longer than other states. Due to this lengthy process, some insurance companies just aren't interested because this process costs more to the companies. They need more actuaries and legal staff and people to process all these objections and questions from the California DOI on why they want to increase rates. So by the time that an insurance company might even finish the process, now they actually might even need new rates too. So it's pretty difficult for insurance companies to really like forecast and ask for the correct rates when like the time period for the process is so lengthy. So that's an issue that insurance companies don't like and have been asking to be fixed as well. This last regulatory issue is this thing called the FAIR Plan that California offers. And it's something that's developed by the state and essentially is a lender of last resort. And it's operated by private insurance companies, and it's funded by the premiums that are paid. But also, if there isn't enough money to pay out on claims, then the insurance companies will pick up the tab and they'll settle it by essentially whatever proportion of the claims that they have underwritten in the past 2 years will be the proportion that they are responsible for figuring out and paying for. However, this can be pretty risky for insurance companies, especially in an unstable environment right now. So even if an insurance company doesn't underwrite any more policies, their risk can actually increase by nature of other companies leaving the state. So for example, imagine your State Farm, the biggest property insurer in California. You underwrite a certain number of policies and you are now going to be responsible for 70% of the claims if the plan is bankrupt. However, all the other insurance companies leave the market, and so now you're responsible for 100% of the claims. And there's also going to be more claims under this plan because there's less companies offering insurance. In fact, you're the only company that's offering insurance. And I want to be clear too. So if you might think, okay, the insurance company pays, why should I care? You should care because the insurance companies will levy a special assessment if they need to, if they don't have enough money in the plan. So that means that you could be in a low in your area, but because there's a big fire and all these people are on this fair plan and there's not enough money, there could be a special assessment that is charged and you have to help with the cost of this. So this issue actually isn't all on the insurance companies. It's not a matter of them being bad managers of this plan is supposed to be actuarially sound, which means that the cost should all be covered by the premiums that they charge. However, when the plan asks for rate increases, they're not all, approved. For example, in 2021, they knew that they would need maybe like around a 70% increase. They didn't think that they would get that, so they asked for a 50% increase and they were approved for a 16% increase. So yeah, you can see the issue there. Also as well, the commissioner has done some things that make the plan more risky. So they increased the coverage up to $3 million, which is something I don't really understand. Why are we increasing the coverage to cover more luxury properties in high wildfire risk areas? So that doesn't make sense to me. Give details on that, and that is something as well that insurance companies have said that, hey, that this is going to increase premiums unnecessarily for people in the plan and cause more burden. Says that the plan really is just like one disaster away from insolvency. So that's something that you really don't want to have happen. So despite all these issues, there are reports that this is actually just a coordinated effort and that insurance companies are leaving the state in order to try and get California to bargain with the companies and, essentially allow them to increase prices and reduce regulation. And what California points to for this is saying that these companies have enjoyed great profitability over the years. And I will say that there is something to that. If you take a look, for example, at the books, also profits over the years.
So, some quick context.
The incurred loss ratio is kind of like your cost of goods sold ratio. It's losses plus reserves over premiums earned. A good loss ratio can vary, but some typical estimates range from 40 to 60%, with higher losses coming from large claim years. There are additional expenses incurred outside of the loss ratio, like commission, but it still gives a pretty good insight into general gross profitability. Here we can see Allstate has had some pretty good years, just with some of the highest losses coming from the 2017 wildfires. Overall, pretty good insight into their general profitability in California. And I do want to say this is where I think that this is something that's good that California does in terms of requiring them to open up their books so that you can get an idea what's going on and don't just take everything at face value in terms of what the insurance company is saying. Some oversight is good in terms of forcing these insurance companies to open their books to ensure that the everyday consumer isn't being fleeced on their insurance prices. However, California, of course, does need to be reasonable. There are increased risk, and by trying to keep prices low for everyone, California is actually making it worse for everyone. So yeah, that's something that does need to be looked at. And yeah, like I said, like overall, my sentiment is that even if this is a coordinated effort, it doesn't really matter because there are actual legitimate issues that need to be taken care of. And that is on the responsibility of the governor, the commissioner, the authorities in charge of zoning. All these people need to take responsibility for their parts in order to get this crisis resolved. Because overall, we cannot have a sustainable model which essentially encourages building in high risk areas and then keeping prices low for everyone. It's just not going to work. And we can see it as evidence right now how it's just completely just not working. I do think California is in a luckier position than, let's say, Florida, because unlike with a hurricane, you can do a lot more to reduce the risk of wildfires with great forestry management techniques such as controlled burns and then proper education to prevent people doing stupid things that might cause wildfires. So there's definitely things that can be done to reduce the risk of wildfires to properties. In the meantime, I do think insurers will come back after some of this legislation has been passed, and the goal is for it to be passed this year. But unfortunately, I do think insurance prices in California are going to go up. They've historically been lower on average, and I think it's just not sustainable anymore when you take into consideration the pretty rapid increase in house prices and building costs. So even though California is addressing some of the wildfire risks and the regulatory burden, I think that we're still going to continue to have high property insurance prices in California until we can really address all those issues, including housing prices. And I don't particularly have any hope that that's going to be addressed soon. So I do think insurance prices are just going to continue to rise and at an unfortunate pace for the near future. Hopefully, California will prove me wrong for all of our sakes. All right, well, thanks again for stopping by. This is Clear Money Tea. If you liked the video, please like, comment, and subscribe. All right, until next time, bye guys.